dead because this one has been dead a lot since over 5 p.m.
Battery's charged. Okay. So, welcome everyone. Perrin recruited me to give my full Bitcoin lecture. Think of it as slightly less technical content and a lot more snark because I've been having to deal with this for a long time.
Yeah, I brought in the big guns.
Yep. Hold on. Got it. Okay, Jesus Christ.
You gotta get rid of the notice.
Yeah,
Is there no mouse?
There's no mouse because
Keynote.
it's in Keynote display mode. Oh, there we go. Got it.
Keynote not having a mouse.
Okay, able to hide that. We are good to go.
Wait, share your screen again?
Oh, I have to share my screen again? Where's Zoom? Share screen. Share. More. Hide floating meeting control. Now, yay. So this is a tweet back from when it was Twitter that kind of summarizes the space really well. You're not getting my rant on AI this time, but here's my algorithm for when I want to use machine learning to solve a problem. I need to build a pattern matcher. I have no bleeping clue what I'm supposed to look for. When I'm done, I still have no bleeping clue what I need to look for, because otherwise I'm going to throw out the machine learning and code a pattern matcher. And it's okay to be hilariously, gobsmackingly, amusingly wrong some percentage of the time. As long as I have that, I love machine learning. I'm a security person. I don't tend to get many cases where being hilariously wrong is considered a good thing. And also, we have a sponsor for this lecture today. Proudly sponsored by Sam Bankman-Fried and FTX, who so glamorously said they were going to give $10 million in cryptocurrency to the athletic department to slap their name on the field. I don't think that worked out so well. Although you do got to hand it to the guy for being an MIT student and the son of 2 Stanford professors. It is a really, really, really good prank to force Cal to rename their field just before the big game. Gotta love it. So why talk about cryptocurrencies? I'm ashamed to admit it, I'm actually an expert in the space of cryptocurrency. It's been one of my research focuses for the past 9+ years, and that's because I actually have a business model. Most CS folks look at the cryptocurrency space, go, this is hot garbage, and ignore it from then on. A few look at the cryptocurrency space, see a way of making lots of money off of suckers by, say, getting venture funding for privacy-preserving machine learning on the blockchain, issuing a token and selling it to retail, and they become true believers. There's very few like me who actually see the space for what it is and yet stick around. And I stuck around because I'm able to mine the comedy gold from the space and turn it into academic papers. I do, however, want it to die in a fire because there's no value to this space. Private blockchains are a 20-plus-year-old idea. If your problem is solved with a private blockchain, the solution already exists in your Git archive. It's called your Git archive. Public blockchains are these grossly inefficient, decentralized garbage that aren't actually decentralized. And they don't actually solve any problems unless you want to implement a cryptocurrency. And the cryptocurrencies themselves do not actually work as currency unless you're a criminal. If you're like the North Korean missile program, cryptocurrency is great. But if you're anybody else, come on, it's just not going away. So let's talk about linked lists. Because a blockchain is literally a linked list data structure. It's a fancy word for append-only data structure. That is, a data structure where you can only add stuff to that causes people's eyes to glaze over and throw money at you. That's the only advantage over any other append-only data structure, is the mind trick. And in the mind trick, there's two splits. There's the private or permission blockchain, where you have some limited articulated set responsible for validating things. And we've known how to build these for 2 decades plus. And then we have these public and permissionless blockchains where anybody can participate. And for them, the difficulty comes into removing symbols, that is, fake users, fake validators. And we'll see later, there actually is no good solution to the Sybil problem other than just identifying things. And then cryptocurrencies, which don't work as currency. So hash chains are a great idea. They're a revolutionary idea from 1980. So the idea with a hash chain is that we have some block of data, and in that block we have the cryptographic hash of the previous block, which we know as being effectively unique and immutable. And so if I know this last block, block n, is valid through whatever means possible, I can thereby transitive validate all the history in an O of n operation by just walking the linked list, verifying that each block has the right hash, and going from there. This also makes it easy to add blocks. That's why it's a good append-only data structure. You just create a new block, put it on the front, hash the previous block, go on, have a nice day. And so you just validate the head, sign the head with a signature, and voila. Your web browser uses hash chains all the time for validating certificates. That the certificate authorities actually have a property these days where they maintain a hash chain of every certificate they've ever issued. And that's a great structure. It's easy to validate. Certificate revocation lists are also hash chains. And then we have Merkle trees. We've heard Bitcoin proponents go, Merkle trees are such a great invention. A Merkle tree is just a hash tree. It is a really stunning data structure from 1979. You want a lot of elements. There's L1, L2, L3, L4, all sorts of elements, and you want to compute a cryptographic hash of all the elements. Well, you just cat them all together, cryptographic hash, call it good. Except that you want the ability to easily add more elements. And so in the traditional way, you'd have to rehash all the data. But if you want to make this hash easy to update, you just do it as a tree. So you've got your elements. You hash the elements, hash the combination of the hashes, and so on and so forth. And so to produce a tree of n elements, you have to do n log n hashes. And you have to do the longest hash. Update is log n. So if you have to update an element, you just have to do the hashes up the tree. And so this is a great little structure for being able to do a cryptographic hash quickly and update all the data. It is also patented in 1979. So let's build a trivial private blockchain. We have a single server S with a public key and a private key. We could all build this. This isn't project 2 because it's too easy. And we have a Git archive, which we fixed to use SHA-256. Okay, so this is a 61B project now. So we fix our Git to use a real hash function. And whenever we issue a pull request, the server validates the pull request, meets the allowed criteria, looks at the criteria, accepts the pull request, signs the hash of the head of the revision, and that's it. There you go. Your private blockchain implementation. That's it. Git is, by definition, already designed as an append-only data structure. And so by signing the new head, we have the ability to authenticate the entire archive. Because hash to hash to hash to hash to hash, and it just goes back. And this is why anyone who talks of a private blockchain revolution is a bullshitter. And I speak of bullshitter in the technical sense of somebody who doesn't care what they say is true or false. Because it literally is anything that would benefit from an append-only limited writer data store already has it. We've known how to build these for a generation. So what's a cryptocurrency? A cryptocurrency is a tradable cryptographic token, and the goal is to create irreversible electronic cash with no centralized trust. So make up a currency, quatlus if you're a sci-fi geek. If Alice wants to pay Bob 200 quatlus to pay off the losing bet on the green thrall, there should be no one else who can block or reverse that transaction. And so it's basically a public ledger. There's a public global shared document, a big giant Google sheet that has everybody's balance. And this magic Google sheet has this property where we can only add things to the Google sheet, not remove it. So the big idea is, given this giant Google spreadsheet, Alice writes a check. I, Alice, pay Bob 200 quatlus, cryptographically sign it, add it to the ledger, and now Alice is up 200 quatlus, or Alice is down 200, Bob's up 200. And so the idea is pretty simple. Alice sends Bob a check. Bob checks in the public ledger to make sure that Alice's balance is good. Depending on the details in the ledger, it's either looking at the old checks or looking at the balance. But Bob goes, Alice's balance is good. Now Bob gets that added to the public ledger, and now Bob's up. Alice is down. And so what is a blockchain? Well, these public permissionless blockchains. Well, the idea there is everybody gathers up the copy of the loose checks. And for each check, you validate that it's valid, that there's sufficient funds. We bundle all the checks up into a block, staple them together with the hash of the previous block. And now everybody just does a lot of useless work. Just basically goes, what amounts to number wang? Change a number, check the hash. Change the number, check the hash. Change the number, check the hash. If you get lucky enough, that basically gets added to it, and you now publish the new stack of checks. And now everybody knows that the new checks are now validated, and so they start processing the next block. And that's how you get this decentralized append-only data structure. And so basically everybody creates a check to pay themselves, keeps tweaking the check until the hash matches, and once one guy gets lucky, he goes, okay, I'm lucky, I now publish this block, and now everybody else goes. So what's Bitcoin? Bitcoin is just the first widespread development of the idea. There's been a lot others. Bitcoin wallets do not store cryptocurrency. They are just cryptographic private key stores. So you've got your private key, you've got your public key, it's all good. And spending Bitcoin is simply writing a check and broadcasting it. So this is an actual Bitcoin transaction. Pay the Ross Ulbricht Legal Defense Fund He was the guy who started the first Bitcoin drug market. And signed by this Bitcoin address, which, that's me. That Bitcoin address I created by having a 16-core processor that I needed to break in, so I had it generate arbitrary Bitcoin addresses until I got one that started with the appropriate text. And indeed, you could look up this Bitcoin transaction, because it's now in the public ledger. And there are nice little services that can allow you to look it up as well. So you can see this is me paying the Ross Ulbricht Legal Defense Fund, and oh, this was just after he was convicted because I felt sorry for his mother. So what's Bitcoin mining? It's just how Bitcoin protects the history. There's a lot of ways you can do it, but Bitcoin just does SHA-256. You've got some fixed capacity. So Bitcoin as a system only supports 3 to 7 transactions per second on a worldwide basis. Yes, the future of money can only do 3 transactions per second. If everybody in this room wanted to do a Bitcoin transaction, it would take a minute. And then you just do the proof of work calculation, which is just basically create SHA hashes until you get one low enough. Because if the SHA hash starts with enough zeros, it's clear that you had to do 2 to that many 0 bits worth of hashes to find one, but it's easy to verify. And then you broadcast it. So remember, proof of work, SHA-256 looks random. So I tweak one little bit on the input, the output looks totally different. And so if I present you with a string of n 0 bits, I, or the collective consciousness that was all trying to do this, had to do 2 to the n hashes. So with a single hash calculation, data, hash it, has enough zeros, you can verify that I or a collective group of I's wasted so much resources. Unfortunately, this has some problems. The first one, this causes bloat. In order to verify that Alice has a balance, you have to potentially check every transaction going back to the dawn of time. So you have to maintain history. And so this is amazingly inefficient. Every full Bitcoin node has to potentially access the entire transaction history. Lightweight nodes still need the headers and the ability to query. And this is common to all blockchains. All blockchains suffer from huge bloat issues. You can try to prune it, but it doesn't work. And this also means that if you have 10,000 people all maintaining the blockchain, not only do you have this big multi-terabyte data structure, but you have thousands and tens of thousands of copies of this multi-terabyte data structure. This is not an efficient way to run a system, is it? But there's also a capacity problem. In order for Bitcoin to limit the growth to just 1 megabyte a block, that is 1 megabyte of data every 10 minutes, there's a transaction limit, 3 to 7 transactions per second worldwide, which means any Bitcoin takes over money requires trusted centralized entities that maintain a centralized database that has everybody's balance in it, and we've known how to build this for a generation. It's called a bank. So how many have heard about El Salvador using Bitcoin as a currency? Well, that's a lie. You see, El Salvador's dictator is a nutcase. But one of the things he got into his mind is, oh, Bitcoin, it's the future of money. Now, El Salvador doesn't actually have its own currency. El Salvador runs on dollars as a way of making sure that the crazies in charge of the government don't print money and collapse the economy. So he declared Bitcoin will be a parallel allowed currency alongside the dollar. We are going to do a new app, the Shivo wallet, that everybody can get on their phone. And when you get it, you get $20 worth of free Bitcoin to spend. And everybody spent their Bitcoin and then never touched it again. But the fun part is, nobody actually ever used Bitcoin for this. They were just transferring balances from Shivo wallet to Shivo wallet in a centralized database. The other thing is Bitcoin has these price shock problems. The price of a transaction, when it's less than the block capacity, transactions are cheap. When it's greater than the block capacities, prices spiral up, and people have caused price spirals for the laughs of it. Ethereum suffers the same thing. Ethereum, it's cheap, it's cheap, it's cheap. Suddenly somebody does mutant ape slurp juices, and the price shoots up for the next day. And nobody can transact unless they're willing to spend 5 times more than they would before. Bitcoin in particular has a power problem. It bounces around. I think it's back up to Netherlands level. But basically, Bitcoin burns 2% or so of the world's power to do 3 to 7 transactions per second worldwide. And this is because proof of work creates this Red Queen's race design. As long as there's potential profit to be had, you get an increase in capacity. So if I snap my fingers and suddenly all the computers on the planet use 1/1000th the power, Jeff Bezos is going to be incredibly happy because suddenly his data centers cost nothing to run. But what happens if I do that to the Bitcoin mines is suddenly all the Bitcoin miners now buy 100 times more mining rigs, and it's back to the same place it was before. There's no way to reduce Bitcoin's power consumption without either reducing Bitcoin's price, reducing the block reward, or changing how this validation occurs to this model called proof of stake, where you just basically have a literally enshrined he who has the gold rules. Because indeed, is it actually the waste of energy that protects Bitcoin? Bitcoin security is based purely on burning the energy of Thailand. But the reason why it's so bad is because of the Sybil problem. There's a lot of talk in the cryptocurrency space about consensus, how the system agrees on the common view of history. But so much of the problem is not consensus, but Sybil prevention. Somebody just spinning up a gazillion nodes, going, I've got a gazillion votes, and the solutions the cryptocurrency folks have come up with are not good. It's either burn the amount of energy to a major country, or literally enshrine a system where he who has the cryptocurrency runs the cryptocurrency. Literally enshrine that. There's an easier way to deal with Sybils. You don't. It's called the CID approach to Sybil prevention. So let's take human-based agreements, identify M trustworthy individuals. In the end, only half of them and plus one need to be honest. They all get together, they all maintain the central ledger, and you could basically do a system like Bitcoin on M Raspberry Pi computers, burning 9 orders of magnitude less power. Why aren't cryptocurrencies doing this? Well, first of all, a non-trivial number of them are lying and actually doing that under the hood. Anytime you see a trusted validator or something like that in the design, you have these hidden trusted individuals. But the reason why the cryptocurrencies don't do this is if you want to be a money transmitter, that is, transmit value from one person to the other, there's all these pesky laws, you know? You shouldn't do payments for drug deals, or you shouldn't allow payments to Russian ransomware, or You shouldn't give money that goes to the North Korean nuclear weapons program. All these pesky, pesky, pesky laws. And that's what the cryptocurrency folks are really all about, is avoiding those pesky laws. The other problem is cryptocurrencies are irreversible. There's no mitigation method. And so a challenge I have to people, buy $1,500 worth of Bitcoin or Ethereum now, transfer it to a public key you control now without either dropping $1,500 in cash, transferring money to an individual and having them do the risk, or having a pre-existing business relationship with the exchange. You can't. PayPal says you can buy Bitcoin with PayPal, right? You can't. You log on, you buy the Bitcoin, they're going to hold on to it. They won't allow you to actually take possession of the Bitcoin. And that's because everything electronic in modern finance is designed with reversibility. That way you can do mitigation, you can do detection and response. Without that, you can only do prevention. And so the seller of a Bitcoin, somebody selling you Bitcoin, must either take irreversible payments, cash only. Yes, the future of money, you want to buy it, bring cash. Either have an established relationship so they can safely extend the buyer credit. So if you have an existing account on an exchange, you might be able to buy the cryptocurrency and move it off right away, maybe. Or you take the deposit from the buyer and wait a couple of days. And so, for example, this individual, I believe there's a room in Soda Hall named after him, lost $70,000 because he didn't follow these rules. He got some free Bitcoin a long time ago and then decided to sell it. And he sold it to somebody who used PayPal. And it turned out to be a stolen credit card, and he transferred the Bitcoin and got ripped off for $70,000. I think the WAs can afford it, but the rest of us can't. But this also makes it easy to steal. You compromise the private key, and it's so easy to take. There's a great article I wrote about 8 years ago, How to Make Money in Bitcoin in 10 Easy Steps. There's actually 11 steps because off by one error, hey. But the result is you can't store cryptocurrency on an internet-connected computer. In fact, the best way we found in practice that works amazingly well to know if somebody breaks into one of your computers is have some small unprotected Bitcoin wallets lying around and just monitor the balance on them. And if the balance ever goes to zero, congratulations, you found out your computer just got compromised. This is not a joke. We actually used this to discover a compromise in our research group because we had some Bitcoin wallets lying around that we were monitoring, and one grad student's account got compromised and it got stolen, and we knew about it right away. So you can't store Bitcoin on your own computer. If you store it on a hardware device, well, what happens if that hardware device breaks? Well, it's gone for good. If you have the hardware device and a pass or seed phrase that's basically 256 bits of random garbage in a safe, well, if that ever gets lost, it's lost. But at the same time, you can't trust anybody else to store your Bitcoin. Because let's face it, how many people thought good old Sam was so trustworthy? Hey, his parents are Stanford law profs. His mom actually specializes in ethics. I know, we can keep my cryptocurrency with Sam. We can trust Sam. And this is actually a big problem. You can't reliably store cryptocurrency with somebody else. You can't store it with yourself. Security experts cannot deal with this. How do you expect normal people to? it gets even better. How many have heard of this program called MetaMask? For those of you who haven't, thank your lucky stars, because this is one of the most awful programs ever made. It is a browser extension that hooks up your cryptocurrency accounts to, or your cryptocurrency keys to the internet. And so you can do things like buy a receipt for an ugly JPEG of an ape. And MetaMask handles the currency transactions. Unfortunately, MetaMask's user interface is best described as awful. Somebody tells you to click on the wrong thing, you click OK, and now all your cryptocurrency is gone for good. Millions of dollars have gone this way. In fact, it's probably about at least 100,000, if not $1 million a day is stolen from people who click on the wrong thing using MetaMask. However, there is good tech support. If you just mention MetaMask on the shitter site, that's how you pronounce it, right? Shitter. You get so many helpful suggestions on provide your seed phrase and we'll help you out and everything else. It's amazing. So what good are these things? There's one thing cryptocurrencies are good for, and that's censorship resistance. That is, there is purportedly no central authority that says, thou shalt not or thou shouldn't have. Well, actually, they do exist. It's these central authorities don't actually want to do their job and don't care about your drug deals. If you believe there should be no central authority on payments, cryptocurrencies are the only game in town. If you honestly believe that, cryptocurrencies are the only thing that provide electronic payments. And so most of the faculty who work in this space and are pro-cryptocurrency, they rub me the wrong way, but there's a few that actually believe in this philosophy. And for those that do, this is the only solution. But the problem is this enables drug dealing, money laundering, criminal payments, gambling, attempts to hire hitmen. The number of dollar value of attempted hitman hires is in the millions. They're so easy to steal because that's why cryptocurrencies are so easy to steal. Because the bank doesn't say, oh no, I'm not going to transfer that. Ransomware and extortion is costing billions a year, enabled purely by cryptocurrency payments. So how ransomware works is the bad guys in Russia break into a business's computers, encrypt all the data with public key encryption, and say, pay me or you'll never see your data again. Now, if you're a bad guy in Russia and you want to get $5 million from, say, Colonial Pipeline or a health network or something, you have three choices: bank transfer, cash, or cryptocurrency. You can't do a bank transfer because no way is a bank going to allow a $5 million payment to Russian criminals with Russian criminals for the purpose of extortion on the memo line. It's not going to happen. Okay, so the bad guys could take cash. Well, the problem is cash is heavy. $5 million in $100 bills is a blob of stuff that weighs 50 kilograms. This is 2 full-weight international checked bags. So not only does the Russian bad guy have to drag these 2 suitcases from the point of exchange, but yeah, you see that hill over there? You're going to get an extra little gift. It's .308 caliber from that Marine because you pissed us off. So the bad guys only have cryptocurrency. And that's only because of censorship resistance. There are some minor good uses. So there was payments to WikiPage and WikiLeaks and Backpage. Oh, wait. Russian Front, criminal enterprise. But they don't work unless you need censorship resistance. Any volatile cryptocurrency requires 2 currency transaction steps because it's the only way to remove the volatility risk. The price is bouncing up and down. So how many have seen Company X is proud to say we accept Bitcoin? And then quietly 6 months later, they just suddenly disappear the offer of accepting Bitcoin. But during that 6 months, they never actually took Bitcoin. Instead, with the exception of a few occasional companies run by complete lunatics, sorry, frog in my throat, they don't. Instead, they use a service that takes the cryptocurrency, immediately sells it for real money, and hands off the real money. In fact, that big stadium deal that the Cal Athletic Department proudly negotiated with FTX to pay for the naming rights in cryptocurrency, asterisk. Cryptocurrency will be transferred to the intermediary in charge of the rights and immediately turned into actual money for the football team to lose with. But if you believe in the cryptocurrencies, you actually must never spend your cryptocurrency. Bitcoin's economics is best described as even more demented than the computer science. It's designed to be deflationary. Now, if you don't believe in Bitcoin, you never want to use it. If you do believe in Bitcoin, you never want to use it because the price is only supposed to go up in the future. So every year, the cryptocurrency community celebrates Bitcoin Pizza Day. When somebody bought 2 pizzas, I think Papa John's, with Bitcoin. Of course, they didn't actually pay for the pizza from Papa John's. They sent the Bitcoin to somebody else who actually paid with their credit card. And the problem is that pizza comes with a pretty big helping of regret, because that's millions and millions of dollars worth of Bitcoin now. Of course, anyone wouldn't have held on to it, would have crashed, whatever. But the basic model is, if you have Bitcoin and some other thing, if you don't believe in Bitcoin, why do you have the Bitcoin? If you do believe in the Bitcoin, don't spend your Bitcoin. You cannot make a viable currency that way. And so all the promised financial applications, cheap remittances, etc., can never apply in a volatile cryptocurrency. If the cryptocurrency is not anchored to real currencies like dollars or yens, it will never actually work. And, we've had electronic money for 2 generations now. And so Bitcoin's only appropriate for buying drugs, paying hitmen, finding out that you paid fake hitmen, finding out that you paid the FBI who was faking the hitman, et cetera, et cetera. Because otherwise, you use PayPal, Venmo, Zelle, M-Pesa, Square, et cetera, et cetera, et cetera. Because those work better. But censorship resistance is the fuel of crime. So before Bitcoin, they had Liberty Reserve, and the bad guys have web money. Web money only works in Russia, so it doesn't, it's not something the US can shut down, but it's also not something US crooks can use. And Liberty Reserve got shut down, prosecuted. So, as I said, the only thing is cash, and so the cryptocurrencies are the only game in town. Drug dealers back in 2013, when Silk Road first hit, hated Bitcoin. There was an interview with a guy on the run from the feds doing a phone interview, describing how he'd have to fly to Las Vegas to exchange his Bitcoin for suitcases full of cash. And you do it in a casino because that's the safest place to do it. Now, there's this notion of a stable coin, which requires eliminating volatility. Not lowering the volatility, but eliminating it. So it just basically, you need an entity that takes dollars, converts them to tokens, and goes back the other way. We've known how to build this for generations. This is literally a bank. Get out the piece of paper in your pocket. You see that it's actually called a banknote. That's because in the old days, banks would just take your coin and print paper for it. Okay, so we have a centralized entity that is responsible for moving money to and from dollars to the crypto tokens. So why do we need a blockchain? I know we could instead have this centralized entity keep a, SQL database, I heard they're called, and just update people's entries and forget all this blockchain stuff? Yeah. The other thing that you see are things called algorithmic stablecoins. These are basically Ponzi schemes in disguise that blow up hilariously. But there's a choice for a bank. Either you become as regulated as PayPal and Visa, in which case, what's the whole point of your cryptocurrency crap? You have a wildcat bank where the bank is printing unbacked banknotes. Or you end up in jail like the folks who ran Liberty Reserve because you're doing a money transfer system that is going to be used by the crooks. Pick your poison. The biggest stablecoin out there, Tether, it's a fraud. Basically, Alameda Research, which was the trading arm of the FTX fraudulent crypto exchange, somehow, over time, bought $40 to $50 billion worth of Tether. Where'd they get the money? Probably they borrowed the Tether, bought Bitcoin, and now the Tether is backed by loans to Alameda Research holding Bitcoin. Basically, Bitcoin's only value is speculative. Somebody else in the future will pay more than you paid today. And there's a supply and demand. New Bitcoin in gets matched by new dollars and new fake dollars. And the bubbles have always been driven by fake money. Back in 2013, the first Bitcoin bubble was created by fake money on the Mt. Gox exchange. For the trivia buffs out there, the first big high-profile Bitcoin exchange that imploded spectacularly was Magic the Gathering online exchange. 2017, Tether blew up the cryptocurrency. And 2022, it was again Tether until FTX blew things up. It's just so blatantly a fraud. But the printer keeps going, so hey. Practically every other cryptocurrency is a Me Too with some riff. There's a lot of cryptocurrencies, they all basically work the same. My favorite, Litecoin, was Bitcoin with a catchy slogan, one of the first major altcoins. Litecoin silver to Bitcoin gold. Ain't that a great slogan? Dogecoin, Bitcoin with what used to be a cool joke. One of the two founders of Dogecoin says the entire cryptocurrency space is awful and should burn on fire, and is even harsher critic than I am now. Ripple is basically centralized Bitcoin with unrelated settlement and securities fraud as a business. IOTA is a fun one. This was centralized Bitcoin that for a while rolled their own hash function. What has Perrin told you about coming up with your own cryptographic algorithms? They did. It gets better. For some reason, they think trinary. There are one kind of people in the world. Those who don't understand trinary, those who only understand binary, and those who understand trinary. For some reason, they think that the number system based on 1, 0, -1 is somehow better. We're eventually going to build computers that run on trinary. Oh, and it's supposed to be used for the Internet of Things. Because you want your light bulb to do a micropayment to a central service when you ask it to turn on, don't you? This is all what you're crying out for, right? Right? Monero is Bitcoin with better pseudonymity. They do mixed transactions. Zcash is a cryptocurrency that has literally money laundering as a first-class feature. That's what anonymity is in electronic payments, is money laundering. Ethereum is Bitcoin with unlicensed security and million-dollar bug bounties. They're great. We'll get to that in a sec. But there's this dream of this space, decentralization, trust nobody. The entire system is trustworthy, but each actor is not. First of all, this requires that there never be a small group that can change things. Now, it's an article of faith among the cryptocurrency advocates that decentralization is good. I disagree because I like the easiness that central authorities do. But the only real thing that decentralized buys is basically no legal obligations for the central authorities. But the reality is they're about as decentralized as a rock. Code is inevitably developed by one or a few groups, and they will change it capriciously. So the Ethereum community loves to shout out, code is law. The notion that what the program says is the binding contract. Until early on in the days of Ethereum, 10% of all Ethereum got tied up into a bad piece of code that somebody went up to and said, hey, code, give me all your money. And the code went, okie doke. And you would think that code is law would mean you'd respect the honesty of the noble hacker who came up to the smart contract and said, of course they didn't. Come on, you're kidding me. They instead stole the money back by changing the underlying code of Ethereum. Rewarded mining centralizes. Basically, the miners are hostile. So the Ethereum network deliberately acts against users. And several things are not just decentralized at all. You've got trusted coordinators. If you have an ability to override or freeze assets, it's not decentralized. But wait, I hear you say, what about all the venture money? Well, first of all, it's gone away over the past 6 months. And the reason why is because the SEC has woken up. Because it used to be, if you're a venture company, what you do is you invest in several companies. One or two of them end up thriving and you sell them off. Most of them fail, but that's the cost of doing business. But the new model, pioneered by Anderson and Horowitz, is securities fraud as a business. You invest in several blockchain startups, like the blockchain startup that promises privacy-preserving machine learning on the blockchain. This said startup issues a token promising that these flower-named tokens are going to be usable someday for privacy-preserving machine learning on the blockchain. I know you don't actually want to do privacy-preserving machine learning on the blockchain, but somebody else will. So buy our flower-themed tokens now, and then when it goes up in value, you can sell it to somebody else who actually wants to do this service. This is securities fraud. A16Z also gets a ton of these tokens, and they also dump on retail. If the SEC ever wakes up, this is blatant securities fraud based on security law that's a century old at this point, almost a century old. And If the SEC ever does wake up, well, A16Z didn't get in trouble because they aren't the ones who committed the securities fraud. It was the founder and the startup that committed the securities fraud. A16Z just advised them that, hey, issue your token for privacy-preserving machine learning on the blockchain. And so this is why all the venture money went into the cryptocurrency space. It's not because they believe in this bullshit. It's not because this bullshit does any good. It's that this bullshit allowed them to create a gig economy of securities fraud where it is somebody else doing the actual criming, and if the SEC doesn't wake up, they walk away. If the SEC does wake up, oh, it was the startup over there that was committing the crime. We just suggested it to them. We helped them out. We took it. But we're as innocent as the pure-driven snow. So what about the non-cryptocurrency applications? Put a blockchain on it. Private or permission blockchains, as we already mentioned, are 20-plus-year-old ideas. The only value of saying blockchain is idiots go, take my money. Commercial private blockchain stuff falls into exactly two categories. One, consultants looting the company because, hey, it sounds good. And two, okay, boss, I need $5 million to redo our back-end infrastructure. We need a new database server, new database, a bunch of software, blah, 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 blah. How does the boss react to that? Yeah. However, if you go up to the boss and say, hey, boss, I need $5 million to provide a Bitcoin or a blockchain-enhanced solution to our workflow, and then you spend $4.999 million on all the previous boring stuff you listed, take the output log, cryptographically sign it, throw it into your Git archive, and go, blockchain! And now you get the funding to do that back-end infrastructure you needed to do. That's what it's good for. And the other thing is those promising blockchain don't actually understand the space. Solve voting, electronic medical records, food security, name your heart problem with a blockchain. They never say what data, how, what formats, what honesty, what enforcement, how do you know it's correct, what's the sensing involved. They just goes over their head. And this is a concrete example. One thing that's frustrated me is there have been repeated blockchain classes here at Berkeley. I attended one session of one of these one time to give a short rebuttal. This was back in the day, 2017, 2018, when I wasn't quite so hostile to it because there was still more amusement value. The two outside experts presented on how they do stuff with blockchain were delusional. So, concrete example. One of these guest lecturers confidently said, you can solve the cold chain problem for vaccines in India with blockchain. So, these days, we all know about the cold chain in vaccines. You gotta keep the vaccine cold, not let it get too hot, etc. But you could forgive somebody in 2019 for not knowing this. And so he goes, well, if the vaccine gets too hot, it's no good, and so we can solve this with blockchain. And my response internally was, no, you fucking imbecile. You sell all of it with these things. This is what's called a warm mark temperature label from Shockwatch. It's basically a label you stick on the package, and if it ever gets too hot, it changes color. That is how you solve the supply chain problem for vaccines, is you put Shockwatch labels on the boxes. no blockchain involved. And this was when I formulated my iron law of blockchain. Blockchain solves exactly one problem. When someone says you can solve X with blockchain, they have no clue how to solve X, and you can safely ignore them. Never underestimate the value of having a zero false negative, zero false positive bullshit detector. This is a 100% no false positives, no false positive bullshit detector. When somebody says this, you know they're bullshit. There is one innovative new stupidity, smart contracts. How many have heard of smart contracts? Okay, so idea. Contracts are expensive, says somebody who's never signed a contract. So let's take things that are written in a formal language. Contracts are written in a formal language. It's called legalese. It looks vaguely like English, but if you try to treat it like English, you're in for a world of hurt. Let's replace that with a horrid language that looks vaguely like JavaScript, only has 256-bit ints, these contracts are fixed once released. And okay, how is this supposed to make things cheaper to start with? Standard contracts are cheap because they're standard. Oh, and let's ditch the exception handling mechanism. Standard contracts have this really robust exception handling mechanism. It's called the courts. But if you can steal from a smart contract, are you actually committing theft? It's actually in the contract. The contract says you can do it. If you ask anybody responsible for smart contracts, they'll go, whose money is it? Is it yours? It's not theft. If it's mine, it's theft. It's kind of strange that way. But the idea for these immutable contract programs on the blockchain came to Vitalik Buterin because World of Warcraft nerfed his spellcaster. How much grief and money would have been saved if World of Warcraft didn't nerf his spellcaster? Blood Siphon, I think it was. Ugh. The horrors of the world. Makes you wonder, if you have a time machine, what do you do? Do you go back and kill Hitler, or do you go back and change World of Warcraft so that they don't nerf Blood Siphon? Kill Hitler. More fun anyway. But the reality is they're basically finance bots. Small programs that run on money. Now, we've had finance bots for generations, for basically 2 generations now. For example, I am a savvy investor. And by savvy investor, I mean I throw it into index funds and ignore it for a couple of decades. And my investments are run by finance bots, small programs that are basically acting on money. The difference is the smart contracts are finance bots running in public. And they're not distributed. And so the predictable result is $1 million bug bounties. So 10% of all Ethereum in a smart contract got stolen before they stole it back. The Parity multi-signature wallet, this was responsible for millions of dollars in losses due to a coding bug. Actually, 2 coding bugs. The first coding bug is somebody could go up to the wallet and say, you belong to me now. Okay, give me all your money. And it would. This didn't wipe out everybody because somebody else, white-hatted, goes, give me all your money, give me all your money, give me all your money. Okay, I'm going to give it back to everybody now. And then there was another bug later on, like a week later, where, hey, smart contracts that runs everybody's wallet, you belong to me now. Okie doke. Oh, crap. Hey, smart contract, self-destruct, no, no, no. Self-destruct, and now nobody can access their money anymore. And the guy who wrote this, the lead developer, was the guy who invented the frackin' programming language. My favorite, though, is the explicit Ponzi schemes. And then we have decentralized autonomous organizations. hey, let's get together and create an organization where everybody invests, everybody gets a vote. Yes, this is something we invented 5 centuries ago in China. It's called the Joint Stock Corporation. But let's do it on a blockchain instead, so if anything screws up, oh well. And let's not actually do the paperwork to be a corporation. So literally, a decentralized autonomous organization that does the paperwork is a corporation. A DAO that does not do the paperwork is an unincorporated general partnership. And this has this notion of what's called joint and several liability, which means everybody is on the hook for the DAO's screw-ups. So if, say, your DAO is in charge of a money laundering operation like Tornado Cash, all the participants in the Tornado Cash DAO are potential criminals. Does this make sense to you? Don't make sense to me. Do your paperwork. Everything else is speed running half a millennia of bad economics. So the cryptocurrency exchanges are fraudulent. Even Coinbase, I consider fraudulent. It's full of marketing things that basically are fake. We've got Ponzi schemes. Ponzi schemes, more Ponzi schemes, some explicit, some implicit. Tether is almost certainly a wildcat bank. Every tradable ICO, they're unregulated securities. We know about these being a problem back from 1720. You've got fun ones, like this was a fun one. I had a choice between AIDS cure on the blockchain and alchemy on the blockchain with its ICO, or ICO, sorry. I went with the alchemy on the blockchain ICO. Your cryptocurrency will be able to turn base metal into platinum. Rare tulips, we've actually had 2 runs through the Ethereum blockchain. So this was CryptoKitties. This was basically the predecessor to the Bored Apes. They're kind of demented little things. Total tulip mania. And finally, because I don't want to see that anymore, and gold bugism. If you want to make an economics professor cringe, ask him to explain the gold standard. My cat doesn't like this either. And now we have the rebranding, the Web3 rebranding. Hey, let's bring the unstoppable censorship blockchain power to the web. Keep in mind, this diagram that I'm going to use is from a proponent of this. So the current web is what's known as distributed. You contract with the DNS provider, who does the name to IP mapping. You contact the web hosting provider, and you pay a few bucks. If any of those object to you, they'll toss you. They'll say, you violate the terms of service, we get rid of you. But you can always find a friendly hosting provider unless you're truly, truly awful. Unless you're something like child porn or something like that, child sexual abuse material, you can find a hosting provider. Actual Nazis have plenty of presence on the World Wide Web, they just don't host in Germany. And then the computation in the current web is a distributed computation between the web browser and the web server. That the web browser is running JavaScript, it's a distributed computation. So let's improve it with Web3. Let's see what the improved Web3 tech set looks like. Well, I still had to have the centralized hosting. I still have to have the DNS infrastructure. I did not manage to remove any gatekeepers at all. But worse still, you end up depending on more centralized providers because you aren't going to access this blockchain directly. Instead, you're going to use a service from the graph. They're going to use MetaMask, which uses other services. So we've added in more central authorities that can and do censor stuff. The only thing that's happened now is you transfer a little cryptocurrency from MetaMask. Okay, more central authorities, more complexity. Damn it, I hope this Ethereum world computer is going to be super duper powerful and cheap to use and worth it for this restructuring of my stuff. Wait a second. You can see where this is going. There's a global minute for Ethereum of 2 million gas per second, that this is how much computation the system does to keep itself from going bloated. Any computation on Ethereum takes some gas on the virtual machine. It's a deterministic computation, so all the copies are running the same computation on the same inputs to the same outputs. The EVM itself is a stack machine that makes the Java virtual machine look sane. If you ever take 164, ask about the JVM. Oh, and it takes 11 terabytes of storage. The simplest computation, let's think about it, is a 256-bit addition. That is 3 gas. So Ethereum blockchain, you can do 600,000 additions per second, total. And the cost bounces around, but it's about $100 a second to use Ethereum as a computer. My Raspberry Pi 4, that can do 3 million, or no, sorry, thousand, million, oh, billion, oops, 3 billion 256-bit additions per second. Okay, so the Ethereum world computer is 1/5000th as powerful as a Raspberry Pi. Oh, and it costs $45 one time versus, ouch. This is how craptacular these systems are. So basically, this space is dismal. The value's non-existent. The societal harms are great. Unless you like being humiliated by a son of Stanford law professors. I don't know. The athletic department might like that. They do seem to lose a lot, so they might be happy with that type of thing. And so basically, either avoid it or make it die in a fire, because it is just bad. So questions on the rant?
There's one back there. What's your opinion about zero-knowledge proof and their implementation on the blockchain?
Zero-knowledge proofs are actually a really cool idea. They date back 30 years as well. In fact, you can think of RSA as being a zero-knowledge proof. There was a great proof by Manuel Blum 30 years ago that you can prove any proof as a zero-knowledge proof. So he could prove that you can prove every proof as a zero-knowledge proof as a zero-knowledge proof. Zero-knowledge proofs are a really good idea. And they're not new, though. What has been new and interesting from that's been derived from the blockchain use is these smaller non-interactive zero-knowledge proofs. So prior zero-knowledge proofs were very big. And the big innovation, mostly by the Zcash folks, was coming up with these smaller zero-knowledge proofs. Now, they're quite good for their intended application of money laundering. Because what you do in Zcash is you put your money in a pool, and then sometime later you publish a non-interactive zero-knowledge proof that proves that that you put money in, that you are withdrawing that money but not tying what is the exact money. So money laundering as a service. They're good mathematically, they're interesting. The problem is there's a real question of how much utility there's been outside the cryptocurrency money laundering space. So technically, they're really cool. Socially, I'd love to see an application that isn't money laundering on a blockchain. Other questions?
You talked about the professor starting a privacy-preserving blockchain. What are you referring to?
You can find out for yourself. But the asterisk is, assume that Intel SGX works, which is not a safe assumption either. So the privacy preserving stuff is kind of bogus too.
I don't really understand what you mentioned about whenever there's a big transaction on the blockchain, wouldn't you be able to just manipulate the price by making a bunch of big transactions? That was back on the slide when you mentioned like, oh, someone bought an 8.
Oh,
The price skyjacked. Yeah.
Oh, so what happens is it's the transaction fees go up. So this is a market, the fee market design for the cryptocurrencies is a inelastic supply, elastic demand market because there's only so much supply. And once you get to the too much supply and demand, or too much demand and demand starts to exceed supply, you get price spikes and price spirals very quickly. And so what ends up happening is the prices go out of control very quickly. And in the space of, say, 10 minutes, the price per transaction can quadruple or quintuple. And the only thing that really stops it is that the price will actually grow exponentially on Ethereum, say, until enough people go and give up.
Because of the limit.
Yeah, because of the limited capacity. That limited supply, inelastic supply markets tend to get price shocks whenever the demand exceeds the supply.
So I guess like a lot of your work has been trying to make Bitcoin and blockchain, public blockchains die in a fire. Like, what do you see is like the next step for that? Maybe the SEC regulating blockchains. How they are, or like what can people do to actually contribute to that?
So write to the SEC and encourage them to keep enforcing the laws. So the SEC over the past year after the FTX implosion has gotten much more aggressive. So they're suing Coinbase because Coinbase, partially owned by A16Z, has this strange habit of listing new cryptocurrencies that happen to be ones that A16Z invested in. And as soon as you actually have to follow the rules, it basically means your value proposition goes away. So like Binance, the Bitcoin exchange Binance, just basically, the head of Binance is basically getting away with financial murder. He's looking at maybe 18 months in Club Fed to walk away with $500 million of his own money. I don't know about you, but I'd take that, thank you. But Binance, the company, is probably dead over the next year because they actually have to enforce things like money laundering laws. They have to not trade unregistered securities. Basically, as soon as you have to follow the existing laws, they basically shut down and go away. And so I've been basically, one of my big arguments to policymakers is you don't need new laws in this space, you just need to enforce the existing laws. because that's what ends up disrupting the ecologies very quickly.
You said Coinbase was fraudulent as well. Could you elaborate?
Okay, Coinbase in the old days was trying to be the reputable cryptocurrency exchange that only had a few, like Bitcoin, Litecoin, and a couple others. Even back then, they were problematic because, for example, their trading of Litecoin, their support of Litecoin, started just after the guy who created Litecoin joined. 95% of the traffic in Litecoin was him trading with himself, and he sold all his Litecoin and walked away. He got prosecuted for this. I don't know if it was criminal or just civil, but this is the kind of thing that Coinbase should have caught right away. It's the sort of thing that Coinbase should have never allowed. More recently, Coinbase has started listing what can best be described as shitcoins. So cryptocurrency tokens that are newly issued with this securities fraud as a business model. And strangely enough, there's a strong correlation between what they issue and what A16Z and the like are invested in. And so I view them as corrupt. Gemini, as cryptocurrency exchange go, is slightly less corrupt, but not by much. So what happened with Gemini is they created a product called Gemini Earn, where you could earn 5% interest on your cryptocurrency by having them loan it out to trusted partners, the only trusted partner being Genesis that dumped it all into somebody who was investing in a Ponzi scheme. And the Gemini folks knew that this was going down and did nothing to protect their customers. And these are the reputable companies in the cryptocurrency space. And basically, as soon as they actually, and that's why they're so afraid of the SEC, that the cryptocurrency folks always go, we want regulatory clarity, because the SEC had been doing hands-off. But as soon as the SEC wakes up, not that regulatory clarity, because it inevitably is, you're selling unregistered securities, you're a broker-dealer, exchange, etc. There is a reason why the securities laws require that these are separate institutions. But the cryptocurrency exchanges, by basically ignoring those regulations, are repeating the mistakes of the 1920s quite willfully in their behavior. And so I don't trust any of them.
Why do you think it hasn't imploded yet? Like the entire thing?
Why hasn't it imploded yet? I don't know. There is a saying on bubbles, the market can stay irrational longer than you can stay solvent. Bubbles always last longer than you expect, but when they implode spectacularly. I think that a lot of it is fake right now, that if anybody really tried to get a large amount of cryptocurrency and turned it into real money, the system would crash. Because everybody's basically, as long as you pretend it's worth something, but as soon as you try to cash out, it fails. The one I'd be watching is the Bitcoin miners themselves. Some of them have been managing to basically do fraud on electric ratepayers instead. So like Riot Blockchain has made more money by not mining Bitcoin than by mining Bitcoin because of deals that allow them to be paid to not burn power kind of thing. I don't know how much unsold Bitcoin there is in the miners. But that's what I think will trigger a collapse. But I thought it would have gonna collapsed a year ago when SBF imploded things.
So, like, obviously the entire like system doesn't really create new value. Yet there's been like a small number of people who've gotten very wealthy. What is sort of the flow of like money and like who's losing it and who's gaining it?
It's a self-assembled Ponzi scheme. So there was no intent in Bitcoin to create a Ponzi scheme, but it basically acts like one. And people make money in Ponzi schemes. As long as you get out before other people do, you make money. It's just it's a zero-sum or negative-sum game. So in the end, you have more net losers than winners. So SBF got rich by stealing money from people. A lot of the others who've made money in cryptocurrency, basically, they made money by being lucky. And so you have a huge amount of survivor bias, or by getting somebody else to do securities fraud for you, like the A16Z folks do.